Gary Christie here from Trading Central's North American Research Desk. Well, we have an update for you on the global markets, and we're going to just focus on some key asset classes here today just to see what's happening, if you're still in this correction, and where do we go from here. So let's just start off with our overall benchmark index at Trading Central. This would be the S&P 500 index. And from the chart on the screen here today, we can see that we are in this decline from the highs we had back in September. So right now, we've seen some pressure, declining trend line in place, a pretty violent one. The question is, do we keep going from here or do we break out? So the S&P right now is in this price discovery mode, trying to find a base and see if we reject it and see if we can retrace back to those highs that we had back in September. But for now, we remain disciplined with our bearish view on the S&P. We have a stop loss at 2742.25 with targets of 2660 to test those May lows, and then ultimately 2555 to testing those near those February, March lows. So for now, if we do break above 2742.25, we may see that retest of this swing high here at 2816. Not all is negative on this chart. We do see some possibility of a bullish divergence with the RSI here, Relative Strength Index. We posted a record low on that over the year, and now we're posting a higher low when price action made a lower low. So this could be a bullish divergence. It's not really confirmed yet. We haven't seen any stop out of our short-term view yet, but something to keep a look on. So looking at the S&P, some of the sectors have been underperforming, but there is one that stands out as still bullish, and that would be the utility sector. So right now, Dow Jones Utility Index on the screen right now, we are bullish above the 701 area. It's pretty choppy, but we're trying to make this new uptrend towards those highs we had in October and beyond. So utilities is the best performer. It looks like some people are moving to safety or some income-bearing instruments. But overall, I would say sectors are looking bullish in the US at least. So here's a quick snapshot of our Trading Central monthly matrix on our sectors. We actually produce this weekly. And right now, the only outperforming sectors are, of course, what we mentioned, utilities. Real estate has come back into play, food staples retailing, food, beverage, tobacco, and some telecom stocks have been coming into favor. Meanwhile, the ones with the most under pressure recently from this week has been semiconductors, banks, all the financial stocks, pharma, insurance, capital goods, and some software stocks. That's just a quick lowdown on where the sectors stand in the S&P 500. Let's just move over to our next largest benchmark in Europe, and that will be the DAX. So here we've identified a head and shoulders top pattern on a weekly chart. These are weekly bars, so we can see that we've broken below the neckline at 11,900 on the DAX, and we are just trending lower here to look to test those July low areas around 10,200. What maintains our bearish bias is the fact that the relative strength index is also capped by a declining trend line, and we are in oversold territory, but we're embedded in the oversold area so that we could remain there for some time before we reverse. So something to keep an eye on. Very bearish to match the US, of course, in the DAX. One currency to mention that caught our radar is the bearish view on the cable, a pound versus US dollar. We broke below a rising trend line here in October, and now we're piercing below that lower Bollinger Band, and the relative strength is below its 50 level and showing some pretty strong downside momentum. So right now we favor short positions in cable below 1.33, that September high, and off to trace towards 1.236. Most likely, first off though, we'll have some support around the 1.265 area where we tested those lows in August, and then a continuation lower with this strong bearish momentum. Looking at commodities, of course, we have to mention gold as it's a safe haven in times like this, and we can clearly see that's what's happening in the metal. We've seen a breakout from a long-term declining trend line in place since April of the year, and we have this consolidation zone, and we finally broke above it, broke above the 50-day moving averages, which are now turning positive and trending higher with the 20-day moving average as well. We have some midterm support, very short term around 12 to 12 area, that's consolidation zone, but most likely we're playing that declining trend line breakout 1200 is a key level that most traders are watching right now in the gold product. So we would see further upside here, anticipating towards 1262 and 1285 in extension. And that would take us to about the 61.8% Fibonacci retracement of this entire swing high back in May to the lows we posted in August. So interesting play here. We'll see that test of the 50% retracement and then a continuation higher. We see some momentum to the upside, especially when we have RSI here as well, pushing to the upside above the 60 level and just moving on over towards the 70 overbought level. But we're not there yet, so we do have some room there. Let's go across the other side of the world, just take a quick peek at what's happening in Asia. And we have a 5-year chart on the screen of the Hang Seng Hong Kong Index. And we want to bring this up just for the fact that we can see clear underperformance with the S&P 500 here, which will be put below on the chart. When we broke below this rising trend line in relative strength against the S&P 500. We also broke below a rising trend line in the index as well. And more interestingly, we are now testing and breaking through that 200-week moving average, a key support area in the moving averages in the Hang Seng. So for now, 28,000 is our stop loss. If you remain below that, we'll keep a bearish view and we'll look to test that 21,500 level back in October of 2017. A pretty similar story for the Nikkei, although it is forming just the same as the S&P, pretty well correlated. What we've drawn here quickly below is the Nikkei against the S&P 500, and we can see this ratio was pretty flat, so we know it's performing pretty much just like the S&P 500. Whatever happens in the US, we've seen kind of the same play out in Japan. But similar story, just like the Hang Seng, we broke below this long-term rising supporting trend line that we've been in place since July of last year. And we broke below it, broke below that 50-day moving average. And now we have a stop loss at 22,500 in the Nikkei, going towards a target of most likely that 200-week moving average in green. It's around the 19,500 level. That's it for us for this week. We'll be posting next month with an update in the view, but keep an eye on it. If you want to follow our social media channels and follow us on Twitter, we'll have updates regularly. Thanks for tuning in. Happy trading.